Hello, everyone. Good evening. I'm Ethan Evans. I'm here with my guest, Peter Mueller. Peter is now at Breakwater Ventures. I've known Peter for at least 5 years. He was a partner at the Sea Change Fund, worked a number of places, including Merrill Lynch. Or were you covering, you were an analyst covering TMT? What is the definition of TMT, Peter?
Yeah, so TMT is a generalized way of saying that you cover tech. In any, we say, large financial institution, most of technology is bucketed into technology, media, and telecom.
I figured it was some clever acronym for a set of segments I didn't recognize. But he covered that at Merrill Lynch, worked at several private equity firms. Sorry, a little bit of a boo hiss there from me, but I'll forgive you.
No, I'm
Um,
in agreement with you there.
I wish I didn't feel that way, but on average, I'm not sure they're helping us. Anyway, maybe that's a topic for another time.
Well, hey,
Uh,
feel free to ask questions around that later as well.
Yeah, okay. So Peter and I have known each other, I think, for at least 5 years. He joined me when I was streaming on Twitch, and we had a number of fun events where he served as the voice of private equity, venture capital, et cetera, explaining some of that to the audience. And frankly, to me, he was our resident quant in a previous streaming life. And so now it's good to come back. I want to talk to him about his new fund. Well, let's face it, the real thing of interest, the real thing we're all interested in is how venture capital works, and whether it's today or later, how one day, if we would like to secure venture capital funding, we can do that effectively. At least I think that's what everyone wants to know. So to begin, Peter, what else would you like to say about yourself by way of introduction? And then we'll talk about your fund a little bit, the stuff you can discuss public.
One quick note, I was an early employee at Carta, which I think will play into the story as to how I got to venture, maybe kind of stepping back and giving a little bit of context as to how I came into venture, because unlike a lot of career paths, there is no validated path as to how to get into venture other than, hey, you become a unicorn founder and you exit and you have a fantastic exit. Like, other than that, VC is not a clear and concise path. So for me, started at Merrill Lynch, TMT, couldn't stand it. I think felt like a cog in a wheel. Bought a one-way ticket to San Francisco. Through luck and happenstance, became an early employee at a company that would soon go on to be valued at $7.4 billion, and was a product manager there. Had a ton of fun, and then was pulled back into financial services through an old colleague at Merrill Lynch and went back into private equity, which was, I would say, an irrational decision given that I had just been part of a rocket ship with immense growth, learned a ton. In terms of time compression and learning compression, my gosh, I think a startup is an absolute great vessel to make the most of your time in terms of learning. Like, Wall Street teaches you how to work, startups teach you how to learn. And in private equity, I really wanted to get back to, I wasn't leveraging what I had learned at Carta and wanted to get back to builders and working closely with them. Venture wasn't really necessarily something that I had in mind, but was kind of on the hunt for another operator role in another startup. And someone had approached me and said, hey, do you want to join Sea Change? We'd love to have you as an investor there. Joined Sea Change in roughly 2018 and was there, became partner, executed around, gosh, how many deals did we do? I want to say 68 deals across 42 companies, and just started Breakwater. So, bit of background on Breakwater. We are a pre-seed and seed fund based here in Seattle, Washington. We'll write checks anywhere from 250,000 to $1 million. We'll lead, we'll syndicate. Our focus areas are AI, ML, enterprise software, B2B software, vertical SaaS, marketplace, and fintechs. That's kind of the quick and dirty additional color there.
Thank you. Jason, can I ask you to drop, if you haven't, the Breakwater link in the chat, just so everyone can see Peter's fund and where they are. So, Peter, I'm going to lead the witness here a little on behalf of the audience and all of our viewers in the future on YouTube. One of the things you want to understand about any given venture firm is their investment thesis. So you gave the areas that you're looking at, but what to you are the types? So you also gave the stage. You're looking to do pre-seed and seed investments in those areas. What else would you say are you selecting for as an investment? Is it Are you landlocked to Seattle, to the West Coast? Are you global, for example? What else are the considerations besides, of course, wanting it to be a good business?
Right. So we will deploy most of our capital in Seattle and Vancouver, BC. So our thesis around, and those are two different theses, but they're somewhat related. Seattle has incredible tech talent. However, if you compare it to the Bay, and if you look at angel investment, very, very different. So the amount of angel capital that is put into startups in Seattle is nothing compared to what it is in the Bay. And I think most people will scoff and go, oh yeah, well, of course. But there's a ton of wealth in Seattle, which made me question, okay, well, why is that? If you look at the levers of wealth creation specifically in Seattle, a lot of it's corporate. So you have Amazon, you have Microsoft, you have Boeing, you have Starbucks. Great. A lot of people have become very wealthy in the region. However, there's not a lot of people that are startup people. There's a culture here that's much more corporate, much more conservative than it is in the Bay. I think in the Bay, everyone will, or most people generally will say, hey, I'm going to be at a startup for 2 years, get half of my equity and hop to something new. Whereas in Seattle, it's very much, hey, I'm going to dedicate 5 to 10 years of my life at a large company. Maybe I'll consider moving to a different company with maybe an elevated salary and a different equity package. But at the end of the day, it's hard to take someone from that type of corporate environment where they are trained to make decisions with at least 80 to 90% of the data sitting in front of them before they go and execute, to put them in front of a pre-seed or seed company where you have at best 25% of the information required to make a decision and have them make an investment. So the angel ecosystem, as well as seed ecosystem here, is much different than the base. So for us, it's very much an opportunity. And the same can be said for Vancouver. Vancouver is, if Seattle's bad, Vancouver is even worse in terms of capital deployed at pre-seed and seed. And in both cities, the talent is fantastic. I think in both Seattle and Vancouver, we have technical depth that the Bay just doesn't have, mainly due to a lot of the people that are coming out and spinning up companies are coming from Google Cloud platforms here in Seattle. It's headquartered here. AWS is here. Microsoft is here. These are companies with incredible technical depth. And if you look at the Bay, they're very B2B SaaS oriented, and that SaaS is somewhat of a solid playbook. Whereas we're entering this era of the necessity of technical depth is required for, I would say, kind of outsized returns across different markets. But getting back to Vancouver, what you've seen with H-1B issuances and other visas is you're seeing a lot more human capital requirements for some of these larger companies in Seattle, but they're not across the US, but those H-1B visas are not being issued. So what happens? They go to Canada. If you look at the fastest growing hubs for the large tech companies, they're either in Toronto or they're in Vancouver. And we have backed some incredible people. We backed Iranian scientists that couldn't get into the US, came up with a solvo metallurgical way of smelting down platinum-based metals to replace kind of archaic smelters. Fantastic technology. The thing is taken off like wildfire and done really, really well. But the capital wasn't there for him in Vancouver. So we met him, we backed him. Awesome, awesome example of just the type of talent that's in Vancouver that's kind of being held over the border that a lot of US investors are hesitant to jump into due to the structuring of shareholder rights. So in the US, we have common, we have preferred.
I'm gonna interrupt you because we're just trying at this point to cover investment thesis.
All right.
One thing you see with Peter, though, that's worth talking about, noting, is there's an idea that VCs sometimes are just bankers with money, and you have to, obviously, if you listen to Peter's depth and passion for the topic, you're not going to approach him with a pitch that's like, let's go to the Final Four together and then you'll write me a big check. The sort of relationship-based investing, he's a quant by nature, and just his depth and passion around these issues. If I simplify, you're choosing to focus on Seattle and Vancouver because you feel your firm has a chance to capitalize on two advantages: lots of strong tech talent and an absence, frankly, of competitive angel funding. Like if I just really boil it down, you're bringing funded to underfunded, highly technical people. Is that fair if we're really simple?
Yes. And I would also say institutional funds, because if you look at the pre-seed and seed ecosystem, even in San Francisco, you have institutional funds playing at the pre-seed level and in New York and in LA, but it's not here in Seattle for some odd reason, and Vancouver, even
So
though
just translating for people again, I'm going to do a little of that. What that means is like Seattle, one of their big VCs is Madrona, but Madrona is not running around providing seed funding.
they are, if you've had a valuable exit for
Sure. If you're already a made person, right? Yeah, great. Yes, okay. So you're absolutely right. No faster way to raise capital than to have already returned capital to some venture capitalists, right?
Yeah, I appreciate you pausing me to simplify it, because I might, please feel free to do that throughout this, because I might have a hard time separating the tree from the woods.
Yeah, which is great because it showcases your depth. But the point on an investment thesis for everyone listening is, relatively speaking, while, okay, very few VCs will ever say they don't want to see a deal because it's easier to say no and have the chance to glance at it and say, nope, nope, nope. But broadly speaking, if someone's investment thesis is in part, we focus on Seattle and Vancouver, and you're in Austin, Texas, you're probably not spending your time best to be focusing on trying to get Breakwater's attention, because they have partners here, which means they can put their eyes and hands on firms here. And for them to take on even a good idea in Austin just represents a different category of risk for them. Now, I'm sure, again, I'll be careful. I bet you wouldn't say that like you would never invest out of region for the right deal. Yeah.
Well, no, but here's the funny thing with how you bring it up, and no need to be careful with me, Ethan. I think we know each other well enough.
Yeah.
We know you well enough. But I mean, that's why we say we'll allocate 70% of the capital in region and 30% will be out of region, is because, just like you said, no VC wants to pass on a deal. If there is a deal with a fantastic founder with a great product going after a great market, I don't want a state line to prevent me getting into a deal to provide my investors return.
Yeah.
So yeah, doors always open. But I think the door's always open in terms of what deals we'll look at. I think there's a lot of VCs that will leave the door too open too long, and they won't give you a solid no. And they'll say, hey, come back to me with X benchmark, or, whatever it may be.
And we're going to talk about how to get the right feedback from a venture capital partner in a minute. Before we do that, I want to tell a quick story that leads into a question for you, which is, I was at the TED conference in Vancouver a few weeks ago, and somebody there started tracking how many times in the different TED Talks AI was mentioned. And by the end of day 4, AI had been mentioned 330 times, including by some guy whose specialty was tracking the migration of monarch butterflies from across North America to where they all sort of gather in Mexico. But even he mentioned AI a couple times. So AI butterfly tracking. It became so required. The part I would ask you is, I'm sure you'll speak for your own firm, but you're also going to be aware of the deal flow for others. Is anything that doesn't mention AI getting funded now? Is there stuff that would still be considered viable if it doesn't say AI in the pitch?
Absolutely. But I think, this is a great question. And anecdotally, I spoke to a great founder by the name of Spencer. He's founder of a company called Commenda out of Bangalore. He's in Seattle for a week. I was talking to him, and he's raising a seed round right now. And he said, hey, I said automation and my conversion to calls was okay. But then I said AI and conversion to calls just took off. And I said, that's great. But what happens when someone asks you to show them your architecture? So let me step back a little bit. I think things that aren't AI are still getting funded. You still have a story that you need to tell as a founder. You still have a market that you have to go after, but you don't need to be AI yet. I think that most pitches that go well, you have some aspect of AI that you have to sell as a kicker. Now, can you live up to that? You should be able to, or else you shouldn't be pitching on that. My belief is that I think I look at a lot of these AI focused funds, and I have good friends that run a couple of them, and I've asked them, you're not investing in foundational models. Everything's going to be AI anyways. And I think that better investors will look past any jazz hands that you might throw up and all of the buzzword bingo that you throw at them, and you'll get discounted. Because if you can't back it up that you're actually building something proprietary in AI, you're not true AI. I think there's an understanding in the investment space that whatever you're doing in your company, you're going to have some sort of AI augmentation, whether it's customer success, whether it's sales, whether it's your core product. If you're
Yeah,
not,
I don't even think that needs to go on the pitch. At that level, if I were doing that pitch, I would have a slide at the end that says, and yes, we're using AI in all the obvious ways. But thank you for basically validating. I've lived through a few bubbles. Look, I was in AI. For those who don't know, I did my master's thesis in artificial intelligence and was working on a PhD in that field when I decided to go into industry 30 years ago. So I've been a believer in AI for a very long time. That said, I now find it comic because I've seen several other things get overhyped. HTML5 got overhyped. Virtual reality and the purchase of Oculus got overhyped.
metaverse.
Yeah, metaverse, which I think of as VR, AR. These things were going to be the next coming of the Lord. And I think AI has a ton of potential, but it's so overblown at the moment. I honestly, if I were trying to invent something, I would go anywhere else. In other words, I'd go in the unoccupied space, because unless I had a truly transformational AI idea, I would go work on some other foundational problem. No, that's just my opinion, but just recognize that the hype is going to overshoot and come back down some. AI is going to change the world, but not yet. Go ahead, Peter.
Yeah, well, I mean, it's that cliche Gartner hype cycle, right? The giant shoot up, and then I can't remember all of the terms that are associated with it, but it's like
the valley of disillusionment comes next.
Yeah.
And I don't know when it's coming, but it's coming, where people are like, AI isn't yet doing everything I ever dreamed of.
I think AI has teeth. The large language models of today are actually pretty fascinating in terms of what they can do, but I think it has teeth, but who will retain the value? That's the issue, right? Unless you're building something that is catering to a very specific consumer or B2B customer, and you're laser focused on a specific vertical or horizontal use case, you're going to get destroyed. And I think there's Ben Thompson of Stratechery always talks about aggregation theory. Stratechery is an incredible blog. If anyone has a chance, I'd go and check it out. But I believe that AI is an aggregation-centric technology, meaning that everything that's built underneath on top of these foundational models, all value will end up accruing to your OpenAIs, to your Perplexities, to these companies that really own those large language models. The greatest example of this is, I don't know how many of you remember Sora and when that came out, and OpenAI's multimodal model. I've been watching a company called Runway, a company that has raised a great amount of money and was purely focused on creating video out of text-based prompts. Laser focused on one problem. All VCs love anyone that's focused on solving one problem. OpenAI just threw a quick sprint together and said, hey, let's make a video creation tool. Let's do that. And in 2 months, they had outpaced a company that had been focused on this exact problem for 1.5 years with a ton of funding. If that doesn't show you how value is going to be aggregated to those that own these foundational models, it's a warning, right? Value is going to be captured by those that are already winning.
So you're describing a winner takes all, or a few winners take most.
Yeah. Well, and I think also another good example of this is I saw Jason mentioning open source versus OpenAI, and there's a good point to that. If you look at, let's take Google, for example. They made Android free. They said, here, take it. Put it on your phones as free. We're not going to create a walled garden like Apple does. Put it on your mobile devices. Everyone took this and ran with it. you see Llama doing something, or Meta doing something very similar with Llama. They're saying our incredible model, Llama 3, 8 billion parameters, 15 trillion tokens, run with it, have fun. And they're making it free so that they commoditize the complementary good so that everyone uses that, makes the model better. And then all of the ancillary services that spin off of it, Meta is built into that and is further accentuating their additional services that they offer on top of it.
There's a common saying, right? Which is, if the product is free, then you're the actual product. And in this case, if you're using the free thing, it is something of a Trojan horse to co-opt you to that platform. And that's what you're describing.
Correct. But you're saying that based off of the current economic model of the internet, which is based around, you're still the product at the end, or you're still giving value at the end of the day. But I think there's something that's been interesting that's been happening a lot. I wrote a piece on this. It's not yet public. But if you look at Reddit's S1, which is their securities filing that they do with the SEC before they go public, 11% of their revenue was selling training data to LLM companies. So if you're not a Meta, if you're not a Microsoft, if you're not a Google, you have to go out there and find training data because all of it's getting locked down right now. And what's interesting about that 11% is it's a good chunk of revenue. And I think we might be seeing a trend within the internet where those platforms where there is user-generated content, there might be a change in kind of product development around incentivizing people to create content rather than consume ads. And if we continue to see this mainly on those platforms where you do create content, we might see this total change in what these products look like in terms of how you use them. They're going to push you to make content, write blog posts, all of these other things to retain that training data to then sell to LLMs. I'm not going to say it's going to upend the ad system, even though there's a ton of interesting things going on in the ad tech space. But it is something interesting to think about as to, do we go into more of a user-generated content-centric internet, at least in some corners of the internet?
All right. Let's transition to, I sort of prompted you before this, how would you like to answer the question, what advice would you give a potential founder who wants to prepare themselves to raise a seed round? What do they need to do? How much do they need to have? We all know it's great if I can raise money with a product and reference customers because I somehow bootstrapped to that point. But if that just makes it easy to raise at a nice valuation comparatively. Here are my reference customers and my revenue and my working products. It's a great situation.
We can go a stage earlier to pre-seed where there isn't any of that stuff. And
well, there often isn't at seed either, right? Like a lot of those are pre-product, at least sometimes. So, well, I can tell you, being older, they used to be even A and B were pre-product because you had to build hardware. Things have moved. But talk to me a little bit about what are the do's and don'ts from your perspective? If a founder is going to approach you at Breakwater, what are your top couple do's and don'ts?
First and foremost, if I see you in an event, don't pitch me at the event. That is one of the quickest ways for me to never answer an email from you. I appreciate the grit, but it's social and professional no in that sense.
Now, can I ask you for permission to follow up? Is that a, like, hey, I'd like to talk to you about my idea. Can I do that later? Is that permissible, or is that also out of bounds?
I would say any fundraise involves getting to know someone, right? You have to trust the individual at the other side of the table, especially at pre-seed and seed. But if you're coming to pitch me at an event, you're going to burn that bridge. We'll use the event as kind of the setting here. Come to me at an event, introduce yourself, tell me what you're working on, and start a dialogue to where you can pitch, but it's much more of me, a total dialogue between the two of us, where I'm asking questions and you're providing answers rather than this, hello, and then next thing you know, you're in your elevator pitch. Make it much more conversational, make it more human. Because if you
of course,
it's not human, it's not going to land. And it's going to
awesome advice. Yeah, I was just asking, I understand the conversational part. I guess I'm asking the middle ground. Is there a good way in an event, or would you say don't do it, to just introduce your idea and say, hey, I'd like to talk to you about this later. Or is that
Yeah, I would prefer that. Like, hey, I'm working on this. I'd love to pitch it on you later, and I don't want this to take away from the conversation, especially if there's multiple people in, say, a circle of conversation. But I would always ask for the follow-up. Now that I think about it, I think it is more above board to do a quick summary run through and say, I'd love to tell you more about it later. Let's get on to the rest of the conversation, because you're showing a bit more empathy to everyone else involved in whatever conversation is going. As someone that's, I would say, an extroverted introvert, when I have multiple people around me, it just gives me the heebie-jeebies, especially when someone is trying to pitch me. Now, I think a good segue into, we're using the modality of an event, which, let's be honest, I don't think most people are, it's a good channel, but most people are going to
let's just pull back. You were very crisp to say, don't try and pitch me at an event. Great, that's one. What's number two? Do's or don'ts?
Don't send me an email that is how many pagers? What is it? A 6-pager at Amazon?
Right. 6-pager.
Yeah, don't send me a 6-pager from Amazon. The best cold emails that I've ever gotten are 3 sentences, maybe 4. You introduce yourself, the high-level idea of the company, either traction, and traction can be denominated in so many different ways, how many people you've talked to, design partners, revenue, whatever it may be, what your intent for a call is. Being a very early stage investor, I get a lot of calls that I think are pitches, but it's actually people asking for advice. I get a lot of pitches or people asking for advice that end up turning into pitches. Be clear with what you intend to get out of a call with me so that I'm not ambushed on the call. And link your deck, and even better, link me a Loom link, which is a video, whatever type of work.
A demo video or something like that.
Yeah, 1 minute quick run through. Those have had the highest conversion for me because I'm able, with very little latency, I'm able to understand what you're doing, what the intent of the call is, what your company is about, and more importantly, a calendar link so that I can immediately schedule up and find a time with you.
Perfect. So that follows advice that other people here have heard from me talking about executives, which is be bright, be quick, be gone. Hit your top 3 or 4 points, ask for the meeting, and you have to trust that your idea is good enough and not have the idea that more is better. Because sure, more is better if they're interested, but if they're not ready to read, the straight metric, by the way, Breakwater's relatively newer, like very new. So maybe sea change, where you did the 68 deals across 40 some companies, would be a better metric. Give some sense of how many people knocked on the door to turn into 42 companies. Was it 400? Was it 4,000? Was it 40,000?
Maybe 10, somewhere in between 8 and 10.
So 200 to 1, if I'm doing the math right in my head. 1 in 200. Yeah. So what that tells you is a VC like Peter, and he's general partner, right? He's a full partner, founding partner at Breakwater, is getting, he and his team are getting 200 pitches for each thing they're actually going to act on. And so, sure, you want to stand out, but you've also got to cut through that.
Some other fun horror stories and
please, I was just going to go there. Tell us 1 or 2 relatively brief, try and summarize them, because I want to get on some other things.
Yeah.
But like 1 or 2, like, oh my God, you won't believe party tricks.
Well, I'll give some other general advice too. No cold calls. My day is packed, day in, day out, Monday through Friday. Saturday and Sunday are catch-up days. If you cold call me and try and pitch me, no. I'm not going to follow up with you. That's like a breach of respect. Any warm intro that you can get into me or any other VC, I'm going to put you at the top of the stack. Today, my day was filled with warm intros, and that's kind of reduced the companies that I was going to schedule time with to about maybe 5 for next Tuesday. And that's, if you get a warm intro, you're slotted to the top.
This is a good point I was going to get here. So thank you. Let me just dig on that for a minute, and then we'll get to your horror stories or your other advice. So warm intro, if you think you're going to want to raise money, or you think this is ever a possibility, start making friends with people in the venture world now. I have not particularly prioritized that, but I know a few people at each possible venture stage. For example, I know Peter at the angel stage. I know some people at the very big ultra mega round stage through my work at Amazon. I know one of the partners at Kleiner Perkins. So if I needed or was at the stage where I need like the make it rain tens of millions or billions kind of thing, you call someone different. The point is build those connections now, because once you have the idea and you want to raise money, it's late and you have to do it through somebody else if you don't know. And Peter, let's talk about the difference for a minute. The founder versus someone you trust introduces you. Obviously, it's still a warm intro if someone you trust introduces you. But even then, how much difference does it make to you? How would you describe the difference between you actually know the person versus someone introduces you?
Are you speaking like pure nepotism here?
I'm more talking about your initial disposition. I'm not talking pure nepotism. I'm
Yeah.
talking about you know them and have seen their work or know about them yourself, and then they approach you or get introduced, as opposed to I
Yeah.
could send you someone and say, hey, Peter, I'm working with this guy, Jason. He's a wonderful young entrepreneur. You should talk to him.
That's interesting. Again, I deal at the very earliest stages. My job is to meet someone at ideation, right? I need to know the product managers that are spinning out of Meta before anyone else does, or else I'm not doing my job. So if I see someone that is creating an online presence and building in public, that's a great thing, but I might be too late there. That doesn't mean that I don't reach out to them. I think having a good content strategy and building in public it is a benefit as a founder. But when I see that, I go, okay, I might be a little late here. Now, I know people at Kleiner Perkins as well, and they will send me stuff that gets pitched to them where they're much more A and B focused, even though they've been doing more seed as of recent. But they will send us stuff that is in our backyard, and they're like, hey, you should check this person out. This person's awesome, incredible founder. You should check. I'm going to take that pretty well, because I would say more than seeing someone in kind of like the public internet, because VC is a very reputational game. You are valued as to who you introduce, what deals you bring to the table, all of these things. I have a good reputation with Kleiner Perkins or Bain Capital or Madrona or Fuse or A16Z, because when I see a good deal that I think they'll like to the partners that I know, I'll send it to them. I'm not going to send them junk. And there's this like code of conduct around venture that you're judged off of the deals that you forward. Sending me a deal, yeah, I'm going to drop everything and look at that, because that's going to be a good deal. They're not going to put their name and their brand sending it to me, even though I'm like a little fish in a big pond. There's still reputational risk at sending someone a bad reference, because when I have a portfolio company that is going out for a Series A or a Series B, I need that Kleiner Perkins introduction, and I need a good relationship with that partner. So it's a two-way street that I need to say, hey, this is a good company. And even if it's not, I'll still provide the context. Here's a portfolio company. These are some things that are going wrong with it, but I still think you should take a look. So it's this kind of code of conduct. I'm absolutely going to look at something that's a warm intro before anything else.
I don't want to run us out of time. There's so many things we could talk about. Give us one horror story, and then we'll open the floor for questions so that people get a chance to ask those. So what horror story? Tell us one, like, oh my gosh, you won't believe what this company or this founder did or tried or brought us.
Well, first off, the pitch went 20 minutes. So that's one indication. Don't have a pitch that's 20 minutes on a 20-minute call. The more important thing is that later in the pitch, there were pictures of my wife and I that he had pulled off of Instagram and put into his deck to tell a story. Creepy as hell. Outside of Twitter, I don't have really an Instagram or anything like that. And if you're posting pictures of me and my family in your deck, that's weird. Breaching that kind of personal, professional barrier there. Other horror stories are, and I have a lot of these, where I'm your first time pitch. That should never be the case. It's your mother, it's your father, it's your dog, it's your cat. Talk in the mirror until you get a good pitch that you can bring to me. Because if it's not clear and concise, I'm going to cut you off and I'm going to say, hey, it's been great meeting you. I think your pitch needs some more work. You need to figure out your value prop, and you've got to get it down to at most 10 minutes. And I'd be happy to talk after that, because Like I said, my days are filled with calls and pitches. And if you don't show up, I'm cutting it off because I need as much time as I can.
All right. We have some people posting questions in chat, but we'll take them verbally in a minute. Jason, I'll let you MC that. So, Alec, you raised your hand. Go ahead and come off mute. What would you like to ask Peter?
Hey, thanks, Ethan and Peter. What kind of opportunity do niche startups have in terms of getting funded? Like we kind of talked about the AI aspect earlier, but a niche startup that is not AI, like what opportunity is there?
I want to touch on this a little bit more than just answering your question, because I think in this day, a lot of entrepreneurs look to VC funding as validation. You can be a fantastic entrepreneur and build a great business without VC funding. Is there for scale. It's pouring gas on the fire. You can have a great idea that every VC is going to tell you that goes on to make incredible returns for you and whoever might have written you an angel check. There is a giant difference between building a VC scale company and building a company. What are some of the niches? I think a lot of them are in hardware. You're seeing a lot of interesting stuff where, as Peter Thiel, not the biggest fan of him, but he has an interesting point where there has been a lot of capture of the bits and we need to move into atoms. And you're seeing a lot of hardware tech come out that has very interesting things, but also stuff that's been underfunded. Femtech is one place for that. One of my favorite stories is vertical SaaS for barbershops, right? Let's be honest. I think tech was very much a white male thing for a while, but two African-American guys came together and built vertical SaaS for barbershops. Very niche, but let's refine niche a little bit more in a venture sense. Vertical SaaS, right? If you can find a market that is still using yellow legal pads and Excel spreadsheets, and you can build product to serve that vertical, that's a niche, but those niches can be worth so much in so many different ways.
That's probably your best answer, honestly. Like, Jason, if you're looking for a clip, to me, that one, there are lots of things that haven't yet been automated, even with all the SaaS plays out there. There are lots of markets that are not yet well served with good software or good apps. And the right piece of good software, a good app, or both can be worth a fortune, even though it's a vertical or a niche.
But it's also purchasing behavior, because after COVID, we saw the largest group of the workforce retire. And what came in after them? Gen X and millennials who have grown up with tech. And we've seen massive adoption in the companies that we've invested in vertical SaaS, because previously it was all like, well, this is the way my daddy taught me to do it, and this is how I'm going to do it on a legal pad. And now you have millennials that are coming behind them after they retired that are like, yeah, I would love software to solve all of these issues. So there also is a broader macro consumer trend in those kind of purchasing mentalities.
Okay. So Peter, one of our viewers in chat asked a question that I like so much, I'm going to ask it of you, which is, because you're very honest, we're going to test your honesty. You've always been honest with me. Is there a deal that you feel got away? Something you said no to that, for whatever reason, might have been really good reasons, that blew up and you're like, oh, we let that fish off. Like, for example, Amazon famously had the chance to buy Google and pass.
Well, there's so many of those stories in all of tech and all of investing.
I was just wondering about, in your 8,000 deals, of which you chose 40, did something go by that you're like, oh, damn?
There are several. I think one is a cool story. I tend to pass on hardware given the complexities of manufacturing and just, my gosh, getting to your first dollar of revenue. And I passed on a company called Electric Era here in Seattle. They do cheap fast charging for electric vehicles. And ever since I said no, the founder's done really well to like keep in touch. And now he's one of my good friends and even came to my wedding. So there's interesting relationships that are formed when you say no and you keep in contact with someone. Another one is Pictory. Man, the list goes on and on. I think
I don't want to torture you with reviewing. We probably have all watched Ted Lasso, and a VC, like everybody else, needs to be a bit of a goldfish. Like, the ball went by, it went in the net, move on. You got to keep playing. But it is interesting.
There's a company called Levels. They do glucose monitoring, and through something similar to a Whoop, we ran by a bunch of medical experts and said, yeah, there's no way you can pull glucose levels off of dermal and subdermal imaging that's currently available in a Apple Watch. And then A16Z came around and did 6 months after we said no, did I think they funded them $50 million, and the company's gone gangbusters since then. So that's probably the biggest one.
And so I take it they were able to do glucose monitoring. Like
Yeah.
whatever they said, whatever you were skeptical of actually did work in the end.
Yep.
Yeah. Yeah. I mean, Alex was asking about niche companies. I would almost argue nothing medical is niche. I'm no expert in this space, but I have where I'm going with this is there's so much money in medicine in if someone can advance the state of the art in treatment, in maintenance, if they can really advance or revolutionize, the world has 8 billion people, all of whom are getting older and who need more stuff. And frankly, of course, as we know, the other piece of that is there's no limit to what you will pay to restore your health. And so I'm not talking about gouging. I'm just saying nothing in, a story I tell a lot, by the way, in terms of invention that shows the same thing. Here in Washington, I was once driving down the ocean and I saw a really big house. And in the next small town, I said, who owns the mansion there? And they said, oh, that's the guy who figured out that if we put clear tape on the edges of a Band-Aid, it'll match everybody's skin. So we no longer have to go for a pink and hope that fits most white people and everyone else gets a weird Band-Aid. We'll just make it clear. That was his invention, and he had a huge beach house.
But I want to check you, Ethan. And Zon, I hope I'm pronouncing your name correctly. She brings up a good point in chat. It isn't easy to revolutionize medicine. And I think you're by kind of painting this picture of so many investors, especially angel, get lost in these, oh my gosh, that product can save so many lives, and they have already developed the product. And I see millions upon millions of dollars get thrown into medical device and medical tech companies because they do make sense. But the hurdles to get to market can take, gosh.
Yeah, highly regulated, for sure. Highly regulated. Absolutely. And I don't want to dismiss it. I'm just saying there's no small markets there. But correct. Yes, they're very hard to access. It's a little bit like hardware. And so the conclusion to me is we need to go collectively, the dozen of us, and start glucose monitoring.ai, and the money will rain. Vineet, I know you asked some questions in chat. Do you want to come off mute and ask one of those?
Oh, yeah. Thanks, Ethan. My question was about the definition of a venture scale startup. Like, how do you define this? Because I've run into founders who say that their ideas are not venture scale and they'd rather bootstrap. An example would be Postman, which is an API client. And there are founders in that space who want to compete with Postman. Some of them are saying they don't want to even go to VCs for funding and they'd rather bootstrap. So what defines a venture scale?
It's a good question. Like, when does a company stop being a lifestyle business and start being eligible for venture? Because venture requires a certain scale in order to be able to possibly return.
Right. Yeah. First off, I can't.
You ask a quanta numbers question, so buckle up, Vineet.
My answer to that is my context I was about to give wasn't going to help. It's first off, VCs give a bunch of generalized advice, and I want to say be wary of any generalized advice from VCs. Right? It always relates to your company, the market you're serving, the customers you're serving. Second, startups and people are incredibly multivariate, so it's hard to tell you exactly what is venture scale specifically, generally. But venture scale is something where I want to invest in a company and I'm going to expect it to triple, double. Now, what is that? I need a company that I can invest in that triples the first year, the second year, and the third year, and then the fourth and fifth, it doubles and doubles. So there's velocity there and scalability there. Now, this comes down to unit economics, what type of flywheels you have in your go-to-market, how sticky is it, what's your retention, what's your net revenue retention. There's so many different variables that are kind of baked in. At the end of the day, it's like, how well can you provide ROI to your consumers and what gross margin that is? Now, and also how quickly can you sell whatever you're making. If you're selling to a highly fragmented market, schools, if you're selling into higher ed, incredibly bureaucratic, long sales cycles.
I'm an angel in an ed tech firm, and I've learned a lot about. That's why, of course, I said that. A lot of damn fragmentation.
A lot of fragmentation and bureaucracy, and then you come to find out that Pearson and these others have locked up 5-year contracts with them that they can't opt out of. There's a lot of complications. But if you look at something like Airtable, they have a freemium model, product-led growth, sales are easy for them. They have great gross margins on this, and they have shown that scale in terms of really growing. Now, that was at the time when they were scaling. Right now, maybe a different question as they try and break into the enterprise, but the enterprise says, no, we already have Excel, like go kick rocks. But I want to touch on the bootstrapping thing. You can bootstrap into a venture scale business. Venture capital and capital, really emphasizing the capital here, we are fuel on the fire. If you bring us and Ethan might like this because I know he's an outdoorsman, but if you make a fire with some kindling and some newspaper, but there's no flame, there's no use for venture capital. You can make a great product, but you need that spark and you need something kind of growing in terms of that flame in order for venture capital to even make sense. And I've invested in 3 bootstrap founders that told me, I'm never going to take your money ever. And then they came back to me 6 months later and said, we don't know what to do. We're getting so many inbounds. Oh my gosh, this product is going crazy. We need more X, Y, and Z resources. Can we do a rep? Yes. Could that make sense? But they bootstrapped into that point until they had a little bit of a flame to where we could really grow that company. So you can always bootstrap into VC funding.
Got it. Thanks.
So we're at 7. I don't want to keep Peter too long, but at the same time, are there other questions? Oh, I know one. Let's assume I've had a pitch call with you. The calls seem to go well. You at least didn't say no at the end of the call, or I think, how do we know if it's going anywhere? So I'm working with a VC. How do I know, is this happening or is it dead? Or
request for a second call, introduction to customers, additional asks for deliverables.
so follow up. You're following up asking for something.
Correct. But it also has to be, your second call is always a good one, but you always want some sort of exchange of either information or contact info to talk to customers in between those calls. If it's, hey, this is great, we'll get back to you, and you don't hear anything in a week, you're done. Because
Move on.
there is no incentive for a VC to tell you no.
Yep.
No incentive. They're always going to leave the door open, because if you start getting traction and you start taking off, and every VC has a story where they've said no too early to a company, they want the opportunity to come back to you because they haven't said no and be, yes, let's entertain deal here.
Yeah, and that was shown really well. I'm sure you've seen this, but for everyone else, Peter, I'll just say there was a comic strip written maybe 10 years ago now called The VC, and it shows a guy, it shows a series of panels, and he's calling the Peter figure and like, hey, Peter, just wondering where we're at. Next panel, hey, it's been 2 weeks, wondering where we're at. Hey, Peter, it's been a month, wondering where we're at. Can we follow up? Next call is at 6 weeks, says, hey, Peter, I just want to say thank you. We've got a term sheet from XYZ, and I just wanted to thank you, but we're going to go with XYZ. And then the phone rings back 2 seconds later, like, oh, they're in. What are their terms? Is there space in the round? I won't say every VC operates this way, but, well, Peter, I'll ask you, how much do you prefer to go alone versus go with others? And does that change by stage?
Yeah, it definitely changes by stage, but that's a great question. At pre-seed, we can lead pre-seed, but we want other people involved, right? Because there's a increase in networks that are available, not only in terms of introductions to leads and talent and other investors in the next round, but also in terms of expertise, right? Like, I'm a finance guy that got lucky and was part of a unicorn very early on, and learned about product and cut my teeth there. But I still need deep technical expertise, or I still need like go-to-market expertise. We try and augment that with venture partners, but I'd rather have a tried and true investor that's on board with us coming into the round that I know damn well that they know how to scale up this company or solve, answer questions that I can't. At seed, it's gotten crazy. Valuations are incredible at seed. I can talk for another hour on why that is and what that causes, but we'll lead seeds when we can. And that's still another party round. I would say the later you get, man, it's very dependent on the macroeconomic environment. I think right now there's more people involved in certain rounds. As markets get better and there are more deals to be had, you'll see more venture capital funds taking entire allocations of rounds. And if I think that's something more reserved for your tier one VCs that have platform teams that have, 300 people on payroll that can really help you to where they feel comfortable about, we're going to take this whole round and we're going to help you and we're going to sit beside you. That's great. But now you're also dependent on just one firm. And if they don't like, let's say you didn't hit the milestones that they wanted you to hit, they'll leave you in the dust. So I always think it's more important to have diversity on the cap table throughout all rounds.
So bottom lining that, most of the time you're looking to get someone to lead, but then once someone's interested in leading, they actually will potentially help you find the rest of the people in the round, because they want that too. So
Right.
At that point, the interests of the founder and of the lead VC are aligned, which is let's find some more people.
Right. But I think also something that can be helpful is when someone comes to me asking for me to write a lead check and set terms, one of the greatest things is, and this is a double-edged sword here, is, hey, we're raising a $1.5 million round. We already have 500K of commitments, and I'm looking to write $1 million check into that company. For me, that's like, oh my goodness, thank God. I do not have to go out and try and sell this deal to fill that additional 500K, which is somewhat of a weird check size to some funds. That's great. But on the other side, is it the right kind of mixture of people? At the end of the day, having soft commitments that you can bring to a lead investor and say, hey, here's capital that I can bring along with me as long as you lead, that's always a bonus, because that's another proxy for traction in your fundraise.
Yep, for sure. So the last comment I'll make there, just my own experience, which Peter, I think, has just explained, is when you're raising money, who's going to lead the round depends on your stage. His company, Peter's company is relatively small number of people. They focus on seed. It means they're not raising huge funds. So he might think your company is the best idea since sliced bread. But if you need 100 million in capital, it's unlikely that his firm is in a position to provide that, right? So he might, and conversely, on the other hand, certainly I was part of a company that got around from Goldman Sachs. Goldman, at least at that time, if they couldn't put 20 or 30 million into something, it wasn't worth their time, because to some level, the overhead of managing a $500,000 investment and a $30 million investment is the same. Same number of board meetings, same number of calls, same amount of due diligence. And so if you're a big fund, to the whole point of who to target, you have to target someone who's ready to work at your scale. And I saw Peter nod, so clearly he agrees with that.
Well, and I think there's additional color there too. I think what you've seen in venture capital is that there's been this incentive to increase fund size time over time, right? We have a 3-year deployment period, as most funds do, sometimes 2, but a 10-year fund. So that means we collect fees over 10 years, but we're really only doing work within 2 or 3. So there's an incentive for some of these companies to raise, 300, then 600, then 900. Well, now you're looking at $1.8 billion in total fees that they're collecting and kind of stacking on top of it. A lot of these mega funds, it's questionable around whether incentives are aligned for them to really step in and help those companies. For me at 30 million, we are purely focused on, like, if these companies don't work, our portfolio, we don't get carry on the other side. So we are heavily incentivized to jump in and help founders. Whereas I think at the later stage, especially pre-IPO stage, they're cutting you $100 million check and they're patting you on the back. they're saying, thank you. We can't wait to celebrate your successes and act like it was all ours. Whereas for us, we're in there, we're building with you, we're trying to solve problems with you. It's a very pre-seed and seed is very different than pre-IPO.
For sure. All right, Peter. Well, with that, I'm going to let you go. I need to run here, but it's been a real pleasure. Peter, we will definitely connect. I will send you a note later tonight. We'll find a time to have that coffee. We're not that far apart. Everyone here, thank you for your time and attention, your good questions.
Well, thank you so much, Ethan, for having me, and Jason as well, and great questions from everyone. So really appreciate the time.